Hello and welcome to my stock scanner. It's time for a little look at the market since we are starting the market out in a very red note today. As you can see here, the S&P 500 futures are right now down almost 2.5% from a Monday morning here in the European markets, and the Nasdaq is down a staggering 4.4%. That is massive, and today I'll have a quick touch on what have caused this. What is the reason for the market to drop this quickly? The reason can be found in China. Maybe you have heard, but China have come up with a new AI model that is called Deepseek. And you are going to hear a lot about that in the upcoming weeks and months. The special thing here is not as much as it's an artificial intelligence model. We have a lot of them, but what it does is basically the same as ChatGPT. Someone thinks it's a bit better, someone accuses it of having been trained on ChatGPT. But the thing is that the numbers the Chinese have come out with shows that this model have been trained on a fraction of the time, at a fraction of the cost, and with a fraction of the needed chips. That is massive. Now, why is that, you might say to yourself? Well, let's have a look at it. What has happened in the market over the last years, if we are looking at Nasdaq here on a weekly chart, is that the market has gone up. Since the bottom back here in the autumn of 22, the market was up 111-12% just lately, and that was partially carried by the expectations of a lot of rate hikes, especially from the gains here back in the autumn of 23. Many investors expected 7 rate hikes in 24. They didn't occur, and you could ask yourself, what have held up the market since then if we didn't have as many not rate hikes, but rate cuts, of course. And the answer is AI. The expectations to AI and the revolutions in way we do things with AI have carried this market up. And then we have seen a lot of the big stocks. We're talking about Nvidia, Tesla, Microsoft, Google, Meta, Facebook, Meta and Facebook. All of these stocks have been carried up because they have invested billions and billions of dollars in AI, in chips, in software development, and so on and so forth. And we were all fairly certain that United States could not be beaten on the AI race here. We have several of the CEOs of these companies that have said United States is 2, 3, maybe even 5 years ahead in this race, which is massive. Now, what comes up next? Well, Deepseek does. And if it's correct, and I'm no expert in AI, but if this is correct, what I have been reading so far, then Deepseek is a bit of a revolution. Not as much in what it can do, but in how much power it takes, how much chip it takes for it to run, and so on and so forth. So that is a reason why we are seeing this drop today, because investors are starting to think, now what if all of these companies that have bet massively on AI, if they have betted wrong, or if they have been too early? So what if they have betted at a time where they had to spend billions of dollars on AI, and all of a sudden they could do with only 1 or 2 or 3% of that? That means they have overspent and that their competitors will gain some advantage. Now let's have a look at why all of this is important and why that doubt among investors can really make the market tumble. First of all, let's have a look here. This is the world PE ratios. We can see United States have a PE ratio of around 26.3, and many of the other Western and also Asian countries are below that. 26.3 means that the investors are willing, on average, in the US market to pay $26.3 for stock for each $1 the company makes in profit. That is a fairly high level, and if we're looking at it in a historical sense, I know this is not the only way you could look at it, but if you're looking at it, we can see that the last time it was this high was back just before the dot-com crash. And there have been some rumors and some experts out saying that the massive focus on only 5 to 10 stocks that carries the entire market is not very healthy. I have said that myself several times. It's not that we see this sort of PE ratio every time before a crash. We can see back here just before the financial crisis, the PE ratio on average in United States were only 15. But the reason for the crash here was the property market that crashed. Then we had back here, this was February 2020. We were in 19.5. Then we had the COVID. Then everything shot up here because, well, the companies didn't make that much money yet, but everyone thought it was going to be okay. So they pushed the prices up even though the earnings were not really there yet. And then we have seen back from October, November 22, due to interest rates, due to AI, this massive run up here. Now, if investors start to doubt this development, if they are starting to say, we think the future is a bit more risky, we are not willing to pay $26.3 for every profit dollar the company makes, we are only going to make 22 or 20 or 15, then we will see a massive cut down in the market. Now, why is that, you may ask, and I'll give you the answer. Let's jump into my stock scanner. This is the platform that we are using. We have built it ourselves, and this is where we do all our analysis. Let's try and have a look at a company like Nvidia. You all know Nvidia. They are producing the chips. There's there's a lot of demand for these chips, and as we can see here in our quality score, it is 100. It's the highest possible. It's massive. There's no doubt that Nvidia is a great company, no doubt. All right, let's have a look in our value chart. Now, with the settings that our systems are making here, it is showing us that the average estimate from the analysts are expecting in 2026 to be the earnings per share to be at 4.45. Now, this is in the beginning of 2026 because they have pushed their earnings season a bit. So it is basically at the end of 2025, meaning this year. So in about a year's time. All right. The interesting part out here is the price earning number, because price earning, as I talked about before, is what the investors are willing to pay for each dollar that hits the bottom line. And if investors are willing to take on a lot of risk, they are willing to pay a higher price earning. The price of a stock always equals the earnings per share multiplied by the price earning. All right. Well, what happens if the price earning starts to drop a bit? Well, if the investors are starting to be nervous, we have three cases here. We have our bear case, our base case, and our bull case. What happens? Right now, we can see that the three cases with the earnings per share multiplied by the price earning gives us a 9%, 55%, 102% scenarios here. So that all looks good. What if people are getting nervous and they are willing to pay, in the bear case, maybe 25 and 30 and 35? I'm not saying it should go down there. I'm just saying this is possible. The 35 is approximately what we had in our bear case before. So in a bull case, maybe 35 if people are getting a bit less willing to take on a risk with Nvidia. Now, with these three cases and with the earnings per share being the same, let's see what that would give us. That would give us a bull case of 9% upwards potential. It would give us a base case of -6, and it would give us a bear case of -22. Now, this is a no-go case for us because we want the base case here to be 3 to 4 times at least in positive what the bear case is in negative. Meaning that if the bear case is -22%, then the base case should be in something like 60, 70 or 80% positive. And it's not. And this is only with meddling a bit with the PE. Let's say they were a bit higher, maybe 30, 35 and 40, like this. That is still not giving us the case we want. However, right now we are only changing the price earning. Now I know the 2025 numbers here are basically in, because they are basically the 2024 numbers. So let's just pretend that these are not gonna change. But let's say that the earnings growth next year will not be as big as expected, because maybe if the investors are thinking to themselves, okay, if this new open source Chinese Deepseek AI thing, if that can reduce the need for chips, then why would we pay so much for so many NVIDIA chips? And if that is the case, then let's say the growth in NVIDIA earnings are only going up by 25%. That is definitely a possibility. And with the 30, 35 and 14 PE, we are still seeing some massively bad numbers here. And this, ladies and gentlemen, is the reason why we see the drop we do today. In Nasdaq, in S&P 500 and so on and so forth. Nasdaq almost down 5% right now, and the S&P 500 futures down 2.5%. That is because, first of all, maybe people are starting to say these AI focused companies cannot make quite as lot in the earnings per share, but the majority is that a lot of risk are being lowered, or a lot of willingness to take risk. So the investors are saying, we want a higher yield. There's only one way you can get a higher yield, and that is to pay less for the stock. So that is this number, and when that goes down, the price goes down, and it can go down fairly quickly. Now remember that if we're looking at the Nasdaq, it has gone up massively, just in 2024, mainly due to AI. Here we saw some gains of 30-35%. Maybe half of that is due to AI. So if that should be cut away, we should see a drop from the top here down at least maybe 15, maybe 17%. We could see a drop in Nasdaq down to 18,000, 18,500. I'm not saying this is going to happen. I'm saying that if the market gets spooked and they lower their price earnings enough, then it could happen. And also remember that we have in both Nasdaq and S&P 500, the majority of the movement so far have been gained by these Magnificent Seven. And have a look at how they have done over the last year or so. If we look at the weekly chart over here, we can see Tesla massively up, NVIDIA up, Amazon, Google, Microsoft, Meta, and Apple. All of them up massively, even though Apple, of course, have been pressured down a bit here, but they have had stellar years. Now, this cannot go on. We have said it for a while. No one can guess exactly when a drop like this will come. But it seems like right now could be some way of an awakening, of people waking up and saying, oh, okay, maybe those PE numbers in 80 or 100 or sometimes several hundreds are not the price that is realistic to pay. Lowering the price earnings will lower the price on the stock, and that is what's happening today. I hope you're not too heavily exposed in these big tech, then you will see a bit of a red day in your portfolio. That's all for now. Checking out, and I'll get back to you again shortly. Bye.